Welcome, everyone. Welcome to Crashes and Taxes. I'm your host for this podcast, Rebecca Walser, and I am so excited to be with you this week because this week we're going to shift focus. We've been so focused on current events, depressing current events, and I just thought, you know what? I'm sort of tired of talking about the same depressing information over and over and over. So I said, let's get proactive. Let's get preemptive. Let's talk about what can we do and where did we go wrong so that we can fix it when we come out of this mess that we are in financially. And we will eventually come out. Now, what remains to be seen is, are we going to be Rome and collapse internally, or are we going to be able to resolve the problems that we have put together over the history of our country? This goes back to the beginning. This is not something that we are responsible for in the last just 50 years. This has been a systemic problem that goes back to the very, very beginning. And it has to do with the way we think of and view money. So today we're going to talk about the three biggest areas where America has gone wrong in preparing for retirement. And we're going to come back and discuss how can we fix each of those areas, because we are in the middle, whether you realize it or not. I assure you that we will not end this year, 2022, without massive global economic shifts of our entire financial system. We are at the end of the central banking system as it has been, as we know it. We are at the end. And whether the end is just merely that the United States dollar is no longer the single reserve currency and it moves to a basket of currencies like the IMF has been promoting forever, or whether we are at what everyone in the World Economic Forum, a lot of the globalists are calling for, a great reset, whichever way it goes, we are going to see a new system by the end of this year. It is happening that fast. So let's get started, because I can see myself going down that direction, and I don't want to do that. So I want to start today, and I want to share some facts with you. And you can see here, we are always talking to our clients about controlling their assets. A lot of money managers talk to their clients about rates of return and yields. And this is what we're going to get you on an annualized basis. And if we get this on a consistent basis, it should do this and you should be fine. That's what most wealth advisors are geared towards, rates of return. Well, that has led to massive wealth gaps in America. Massive. And so I want to talk about what is our wealth gap in America, and what are these three major things that are problematic. So as you can see here, I've got control your wealth, maximize your assets. So when I'm in my practice, one of the most important things that really has an impact at my practice, Walser Wealth, is we aren't just talking to the client about the return. We aren't just talking to the client about our money management capabilities, which I think are great, and I put them up against anyone's. But what I'm trying to tell you is that is just one of the pieces of the puzzle, of the pie, just one of the pieces. And no wonder we have such a large 22 trillion wealth gap. And I've mentioned that number to you guys before. So let's go through some slides here. And I want to talk to you about the very first flaw of how America retires. I'm going to see if I can change this for just a second so you can see the beginning of this. Yeah. So I know this is really tiny on your screen now, and I'm going to make it bigger, but I want to just show you that this is the S&P 500. That's what we call its inflection points. And this is a chart that goes from 1996 through March of 2022, because as I'm recording this, it's the mid-April timeframe, end of April timeframe. And so we're in the mid to end of April, and we don't have April's results yet. So this is only going to go through March of 2022. And so I want you to see here, I made this smaller so that you could see that this starts at year 96. So I'm going to make this a little bit bigger now. And I want to walk you through this. So you'll hear me, you won't see me for just a few minutes. As I walk you through this graph, So this is very important because America, when the 401k became the default retirement savings vehicle, which it really did become in the early 80s, it was written into the Revenue Act of 78 as a corporate tax dodge for highly compensated executives that already had their golden parachutes. They already had their pension plans. There was a really cutthroat need for top executive talent. And so companies were trying to come up with additional ways to recruit them. And they came up with this 401k, which would be an additional payment, but they would be able to defer the tax until they separated from service or took distributions. And of course, you can roll it over to an IRA. So here's the S&P 500. We have been convinced that since the 401k really came into prominence, that market equities is the way for us to grow our wealth and retire. And so what I want to point out is that we pull this chart back to 1990. From 1990 to 2000, the market went up 417%. So 417% growth. And why is that? That is still to this day our deepest bull market in the history of America. It's because that is when the internet was released from the military to private businesses for the first time in that 10-year period. And we went from beepers to cell phones. So cell phones came on the scene, not smartphones, but regular cell phones, just mobile telephones, really. So we had cell phones, and then we had the internet. And that was enough to, I don't know if you guys remember pets.com. I think it was like a unicorn. It was really literally worth $1 billion before they had even figured out e-commerce and how to actually sell a bag of dog food. So we went up 417%, and that remains to this day our deepest bull market run in the history of our country. Then you can see that starting in March of 2000, we hit 1527. We had 3 years in a row of negative returns, dropping us down to 777 by October of 02. This is the Fair Housing Act, where we had basically a recovery because the real estate market really took off and we recovered. But you can see, and I want to point this out for people that think that the market is like the only way to go. I want you to see what happens in the absence of Federal Reserve support and the absence of accommodative fiscal monetary policy. And that is from March of 2000, we were at 1527. October of 07, we're at 1565. So here it's 7.5 years, and the market didn't even grow 40 points. And the irony of all irony is the second we finally get growth back and have a little bit of a recovery from our previous March of 2000 high, we have the GFC, the global financial crisis, or in America, we call it the Great Recession. And you can see 18 months top to bottom, October of 07 to March of 09, we dropped 57% in the S&P 500. So this is, I call this fast and furious. 18 months, 57% is pretty fast, pretty furious, especially considering that it took 3 years for us to lose 49% in the earlier dot-com crash. So we lost 57% in that time frame. And this is really where everything changed. In 2008, President Bush II decided that General Motors was too big to fail and that they would bail out. And Obama came in January of 09, and he in fact did bail out General Motors. Then we had the Troubled Asset Relief Program, which is the TARP program that bought the toxic assets of the bank's balance sheet. So after TARP, after bailing out GM, we started to get this mentality of too big to fail. We can't allow these institutions to collapse. We must fiscally help them. It's too many jobs. It's too many households. It's too much. It's too much of a problem. So we then started quantitative easing 1, 2, and 3, and then we stopped really counting because we've been doing it consistently since that global financial crisis. The global financial crisis, that's what set off Greece with austerity. We had Spain, Italy. We had a lot of European countries that were really just totally bankrupt and had to get things in order, and they still are. So let's look at what has happened. We had here, before Corona, we went up 401% from March of 09 through February 19, 2020. So we had basically almost a 11-year bull run. This is our longest bull market in the history of America, not our deepest because it's only 401 and we know 417 was over here. So it's our longest bull market, only interrupted by the world voluntarily shutting down globally for the first time in the history of the world. We would quarantine healthy people and not escape herd immunity, not put ourselves out there. So you can see that the market dropped 34% in 5 weeks because of the shutdown. And this is when the Federal Reserve and Congress and the president got involved and said, okay, we're not going to go into a Great Depression here. We're not going to let this happen. And so they artificially supported the economy through both legislative means. We know we had the CARES Act, the HEROES Act, and the American Family Plan, AFP. Those three acts alone were about $6 trillion. And then on top of that, we had the Federal Reserve pumping out or buying $120 billion of treasuries per month. So that's them putting $1.3 trillion into the market. So we had about a total in America of about $10 trillion that was passed, printed, or promulgated because of coronavirus. And so that leads us to this recovery line. And you can see that this recovery line from March of 2020 to March of 2022, this 2-year beta window here, you can see that the market recovered 102%. That is almost a straight up line. This is one of the most highest recoveries we've ever had. And whenever you have a slope of a line that is that straight up, it lets us know that it is inflationary. It's not based on economic fundamentals because the slope is just too great. It's shooting straight up because it's inflationary. So we had all of this currency that was pushed into America to allow us to not go into a Great Depression through multiple different channels. And what ended up happening was that money found its way to two places, real estate and the equity markets. So equity markets recovered and then went further by a lot, by obviously from the high to this. So that's the recovery there, about a 70% run up versus everything else that, and then real estate, of course, we know. So here we are, end of March, talking to you in April about this, and you can see that we are at 45.30 and as of the end of March. And yet this is not supported by the market economic fundamentals, which is why we know we're in a retractionary period with the market. So let's just look. I want you to see the pattern. And I know that I probably can't really draw it for you, but I'm going to try really fast to see if I can actually. So you had, I got to put myself back on here. So you had a 10-year bull market, 417% up, followed by a dot-com crash of almost 50%, followed by a pattern of years. It took at least 5 years to recover from that. And that once we recovered, we crashed on again. And now we've had this 12-year straight up bull market with the interruption of Corona exempted or accepted out of that. And so what we're seeing here is what I call in my book, the new normal. The new normal is extreme, is basically market volatility. It's extreme highs followed by extreme lows. Now, if you retired anywhere here in this 12-year period, you're probably very happy. You retired at the top, you got your money hopefully a little bit safer, and you're fine. But what happens if your 10-year retirement was to come between 2000 and 2010? How do you retire in a 10-year bear market that is the first time in history, a negative 10-year period, a lost period? We call it the lost decade. That's what it's called because it's the first time we ever lost 1% or any percent over a 10-year period in the market. How are you supposed to live off of a 10-year period where the market's doing nothing but going down over that 10-year period? And then, of course, we're retired. So we're pulling money out of a down portfolio, which is basically locking in our losses and losing our probability of success, that portfolio is going to be able to be sustained over your entire retirement lifetime. So that is a problem. What this means is relying 100% on the market is a problem. It's not something that is going to work. So that's the first problem. The first problem is America moved to a market-based retirement system away from what we call the defined benefit pension world, where you would get a paycheck for the rest of your life when you worked at a company until death. You would get that paycheck between the pension and your Social Security and whatever savings you made. Most Americans were living quite comfortably in retirement, but that is in fact not the case anymore. And so that leads me to want to talk to you guys about what is this retirement wealth gap? What is our retirement wealth gap? It's about $22 trillion. There's a lot of recent analysis on the racial retirement wealth gap and the differences between the races. But right now, I just want to focus on all Americans. We have about 22 trillion. What does that mean? And you can see this is an article from MarketWatch, which is dated June 15th, 2019, that tells us that we add about $3 trillion to our retirement gap each year. Retirement gap means what is the gap between the assets that we should have saved and put away in America in order to maintain lifestyle and retirement versus what we actually have done. And that gap is 22 trillion. And in this MarketWatch article is letting us know it's growing at $3 trillion a year. That was before Corona. During Corona, the world globally printed $30 trillion and counting, by the way. There's a lot of stimulus that's still going on. China shutting down with their zero COVID policy and all those things. So there's a lot of stimulus still going on. So we are continuing to not put enough away. So we're not putting enough away. And then what we are putting away, we're putting into a very volatile market, the new normal of the market since the 90s, since the internet, since extreme high highs, followed by extreme low lows, followed by the Federal Reserve basically over accommodating since 2009 or 8, over accommodating the stimulus, the free money, the basically next to zero interest rates. And we have just had this massive market run up. And then Corona happened. And then we printed more money. And we finally have been able to show that MMT is a non-viable economic theory, modern monetary theory, which believes that a government entity can print money incessantly without ceasing, and that there will be no impact of that money being printed as long as the interest can continuously be served. We see that that is false because when the world printed $30 trillion, we got hyperinflation. Now, they're not calling it hyperinflation. You're just seeing the PPI over 11, and you're seeing, which is the producer price index, and you're seeing the CPI at 8.5 year over year. But that excludes food and energy by design, core CPI. When we add in food and energy, we're somewhere between 12 and 18% real total inflation, i.e. hyperinflation. So MMT should be killed as an economic theory because the whole world did it, and now the whole world is suffering inflation. So that is a problem. This is why gold and commodities are shooting up massively. So our second problem is we're not saving enough. But yet what we are saving, our first problem is that we are saving in 100% market volatile locations. Of course, then our third problem comes to taxes. We have not only saved not enough and in a volatile stock market as our main primary goal, but we also have saved it pre-tax, tax deferred. And we've deferred our tax at the same time period that the baby boomers will be retiring. So if you're retiring anytime now until the next 20 years, you are going to have an impact from the fiscal impacts of the retirement of an entire generation for the first time in block, in mass, moving out of the workforce, some 65 million people over these next 6 years to 2028, 65 million people moving out of the workforce and moving on to Social Security and Medicare. That is the double whammy that we have been preparing for and waiting for, because tax rates, according to the Congressional Budget Office in 2008, for middle-class Americans must reach into the 60s in order to pay all of the benefits that we have promised the baby boomer generation through Social Security and Medicare. So we are on our path to becoming Europe. If you wanted to know why Europe's tax rates are so high, it's because they've been around for centuries and they've had social safety systems that they have had to collect taxes on. And this is the European system. It's a quasi-socialistic privatized system. And this is what America has now become. And this is why the retirement of the baby boomers is going to put the final apple cart upside down tax situation where it's going to bring the chickens home to roost. So you have to ask yourself, if the IRS is looking at your, let's say you have $2 million in a 401k, $500,000 in a 401k, $300,000 in a 401k, and you're looking at that 401k as I have 2 million, I have 1 million, I have 300,000, 500,000, whatever your number is. Remember that the IRS is looking at the same pile of money that has your name on it as their money as well. So, the last thing I wanted to give you is just a little quick tip about how things can be done differently and better. And basically, what we do at Walser Wealth, at my business, is we basically build you a fiscal house. We use alternative asset classes. We use sophisticated option strategies. We are not 100% dependent on the market in and of itself, because we know it's the downside that will absolutely kill us mathematically. And we cannot take a chance in our retirement getting messed up because some virus comes along or something comes along, and now we have to shut down and we have to print a massive amount of money to avoid a depression. And now the dollar is hyperinflating and we are on the precipice of losing dollar as the world reserve currency, which I have already discussed with you guys in many other podcasts. So there's a lot going on. And so what do we need to do to fix it? Well, if the problems are that we are using only a volatile repository that will not serve us for our entire lifetime, if the problem is that we're not saving enough, and if the problem is we're saving pre-tax, then we need to tick off those problems in the reverse order. Number one, we need to put more of our budget towards our future. You know, every single dollar you make is going to pay one person or another. It's either going to pay your future self, meaning that you aren't going to consume that dollar right now. You're going to say, this is for my future self. You're going to preserve it for your future self. And that's when you're going to get paid in the future, or you're going to consume it now. The reason we have a $22+ trillion wealth gap is because we consume now and we forget about our future self. We need our future self to come speak to us in the mirror in the morning and say, you need to save more money for me. Because there's not going to be anybody to blame except for yourself when you're staring in that mirror in retirement, you don't have enough. So number one, we need to save more. We need to live at a lower lifestyle, and we need to put more away for the rainy day. As a country, everybody, all of us, it's a systemic problem in America, in the world, but also in America especially. We like to have things now. So we need to save more. Number two, we need to save tax strategically. If you do not have a financial advisor who's given you legal domestic tax shelters to use and leverage, then you're missing the boat on that. We need to save strategically from a tax perspective. We need to make decisions through a tax lens. If you're not doing that, big mistake. It's going to come back to bite you. And then third and finally, we need to leverage alternative asset classes, option strategies that don't necessarily rely on the whims of a market that goes up and down like nobody's business, especially post-corona in 2022 and beyond. Those are our three ways to fix it. We can do this. We can tackle it. We can make this happen, but we have to get serious about it. And the younger you are, the better you have the opportunity. But that doesn't mean it's too late. Do not think it's too late. I'm 65. I can't do anything. I work with people that are already retired, and we restructure and we fix things and we get them done. So there are good people out there that can do this for you guys. You just got to reach out and find them. So until next time, my friends, enjoy your weekend, and I will talk to you guys next week. Take care.